Imagine a time when you invested your hard-earned money, with no real way to know if the information you were given was true, complete, or even intentionally misleading. This was often the reality for investors before a pivotal piece of legislation changed the landscape forever. It led to significant losses and a profound erosion of trust in financial markets. Full disclosure under the Securities Act of 1933 refers to the fundamental principle that companies offering securities for sale to the public must provide all material information necessary for investors to make informed decisions. This means revealing comprehensive and accurate details about the company, its finances, its management, and the securities being offered, effectively allowing investors to see the complete picture. The core reason behind full disclosure is rooted in the widespread financial abuses and lack of transparency that significantly contributed to the 1929 stock market crash and the subsequent Great Depression. Before the act, investors frequently bought securities based on incomplete or even fraudulent claims, leading to devastating losses. Congress enacted the Securities Act to restore public confidence in capital markets by establishing the principle of truth in securities. Its main goal is to protect investors by ensuring they have access to all information that allows them to assess the risks and potential rewards of an investment. This transparency helps to deter fraud and manipulation, creating a more equitable and trustworthy playing field for everyone involved. Companies fulfill this critical obligation primarily through the filing of a detailed registration statement with the Securities and Exchange Commission, or SEC, before offering securities for sale. A key part of this statement is the prospectus, which must be provided to potential investors. This extensive document outlines everything from the company's business operations and financial health, including audited financial statements, to the specific risks associated with the investment, and how the proceeds from the offering will be used. It is a thorough and exhaustive account designed to leave no stone unturned for the investor. An important aspect of this concept is the definition of material information itself. Material information is generally considered any information a reasonable investor would consider important when deciding whether to buy or sell a security. This is not just about avoiding outright lies but also about preventing omissions that could mislead. The SEC, through its enforcement actions, continually reinforces that this obligation is not merely a formality but a core pillar of market integrity, requiring ongoing vigilance and accuracy from issuing companies. Ultimately, the principle of full disclosure transforms opaque financial transactions into transparent opportunities, allowing investors to understand what they are buying. This foundational concept ensures that the capital markets operate on a basis of informed decision-making rather than blind faith, thereby strengthening the entire financial system and protecting the individual investor from unforeseen perils.